good afternoon, everybody, and welcome to the next in our series of Essentials. My name is Dale Franklin, and I'll be guiding you on our journey today. Certainly when it comes to bubbles, it's the thing that often terrifies most fund managers. You either get it very right or very wrong, and it can make and break fund managers. So taking us through our journey on bubbles is firstly Peter Little. Peter Little has worked in financial markets since 1997, initially in London, and then in New York before moving to South Africa in 2013. He's part of the Anchor family and has been here basically from day dot. He worked in a number of global banks, including JP Morgan's, Barclays, and the Royal Bank of Scotland. The next speaker is Nick Dennis. Nick Dennis is the current Raging Bull winner of 2020. He manages the Anchor Global Equity Fund since March 2015. Before joining Anchor, Nick was a senior investment manager in the emerging market teams at Picto in London. And with that, we're going to get started. So I'm going to ask if you do have any questions, to please put them in the chat function. We will try to get to as many of them as we can by the end. And once again, we will send out a recording of this after tomorrow. Also, this video will appear on the Anchor YouTube page. We'll apply for CPD points straight after, and hopefully you should get them within the next month. Thank you very much. And Nick, Peter, over to you.
Thanks, Dale. Thanks for the intro. Let me share some slides quickly. There we go. Hopefully you can all see that, and hopefully you can all hear me. So as Dale said, we're going to start off with me. I'll try and entertain you for about 20 minutes before handing over to Nick, who should chat for a similar length of time. So what I'm going to talk about today is mostly the sort of macro level, regional level bubbles and how we think about those. Nick will focus probably more on some of the industry level stuff or the company specific stuff. But just in summary, what I'm trying to talk about today is what is a bubble and what differentiates that from just a regular bull market. I'm going to say that size matters, maybe not so much in life, depending on your opinion, but it certainly matters in bubbles. And I'm going to talk about why I think that's the case. And then I'm going to delve into a few historic asset class bubbles and try and extract what we've learned about those. And then lastly, I'm going to tell you a little bit about how I think you could avoid bubbles. And actually, I'm going to talk a little bit about whether I think that's actually a good idea. So let's get cracking. So this is a slide that I've taken from a presentation by JP Morgan, where they talk about how assets go from bull markets into bubble territory. And starting on the left-hand side here, if we think about this is the price and this is the time frame. So starting on the left-hand side here, we see asset prices are going down. There's been an event and things are not looking good, and prices are going down, but the fundamentals, the environment starts to change. So things start to get better, but prices are still going down. Investors aren't buying that change yet. They're not seeing the silver lining. They think it's probably just a dead cat bounce. You know, this is the time when you're saying, the rand's going to 50 or construction stocks are going bust, and you're very negative and you're extrapolating that negativity into the future, despite signs that things might be getting better. Then that moves us on to the next stage where things are getting better and they're starting to get incrementally better. So the improvement is accelerating and people are starting to say, you know what, maybe this is sustainable. Maybe we have turned a corner and this is the inflection point. And so asset prices start to bubble, to bottom out around that time. And then as more and more people buy into the fact that this recovery is potentially sustainable, prices move higher as the momentum gets behind them. And it's normally around that point that fundamentals are still good, but not improving at the same incremental rate. But prices are still going up. So fundamentals are still good. They're still getting slightly better. They're not improving at the same absolute pace, but they're getting better, but prices are continuing to improve. And this is when we start to see asset prices being driven to a point where, at least on traditional metrics, things start to look a little stretched. So PE multiples are high, and credit spreads are pretty tight, and yields are pretty low. But there's normally a compelling narrative at this point to say, you know what, it's different this time, and this is the reason why it is. And that compelling narrative is enough to keep people invested, and it's enough to suck in speculators. So this is a point where you sort of head out of bull market territory into bubble territory, when you start seeing speculators enter, and often enter with leverage, trying to make a quick buck. And this is when prices get driven to extreme levels. And then usually we have some sort of macroeconomic shock at the top here, and prices come tumbling down. And that macroeconomic shock is often a regulatory intervention. It's actually usually a central bank that intervenes and causes things to collapse, and prices revert to more normal levels. In fact, frankly, the prices tend to go well past reasonable levels and become pessimistic again. But so that's kind of the path of things going from bull markets into bubbles. And as I say, this last little section here, when things move into bubbles, it's normally the function of speculators and leverage, too much leverage getting drawn in there. So that's what we think a bubble is and how it progresses. As I said earlier, I thought that size was particularly important for bubbles, and I'll talk a little bit about why I think that. So on this chart, I've got these bars representing various different asset classes or economies, and these numbers are in trillions of US dollars. So the global stocks are worth about $115 trillion, US stocks about 47 trillion, US homes owned by private individuals are worth about $32 trillion. And the US economy is about 21 trillion. And you go all the way to cryptocurrencies. If I add the value of Bitcoin and Ethereum, I get around $1 trillion. Probably if you add in all the others, maybe 2 trillion. And Tesla as a company is about $0.6 trillion in value. And so I think there's two reasons why size matters. And the first is that the length of a bull market and turning into a bubble is usually a function of the base effects. So if something starts off pretty small, its ability to grow at above average level for significant periods of time and to grow at multiples of its own value is much more sustainable than if something starts at a high level. So think about, for example, purchases of some sort of fairly small part of your budget. So streaming services, Netflix or whatever the case. It's a relatively small part of your budget. So people can start increasing the spend on that type of category by multiples. You can increase the spend 5, 10 times, and it's still not a meaningful part of your overall retail budget. Whereas if you take something like car purchases, which make up about a quarter of US retail sales, it's unlikely that can sort of double and double again for multiple years from an already high level. So that's the first thing to take into consideration. The base is really important in terms of how quickly things can move along. And then the other reason why size is very important is from a systemic perspective. So if we see, for example, a correction of global stocks of 20%, that's over $20 trillion of wealth lost around the world. That's more than a single year of economic output from the US. So that's a significant event that's likely to cause massive consequences for confidence and liquidity and have knock-on effects into other parts of the economy. So that's where bubbles can become systemic when asset classes are, where the assets in question are particularly big. And by contrast, I've got a thing saying here, a 1% correction in stocks, which is something that we see frequently on a daily, or not a daily basis, but on a weekly basis, or at least a couple of times a month. You see stocks correcting by 1%, and that wipes about more than $1 trillion of global wealth of investors in stocks, which is more than the entire value of Bitcoin and Ethereum. So you could lose that 1% correction in stocks, which people barely even bat an eyelid at, could wipe out more than the entire value of cryptocurrencies. And the point here is that if you're in obscure asset classes, already small asset classes that don't have systemic ripple effects to other parts of the economy, it's unlikely that you're going to get support from central banks to come in and stabilize things. So the takeaway is here is don't have too much of your clients' wealth invested in things that could disappear without so much as giving the Fed or central bank a sleepless night. So I'm going to jump straight into the history of bubbles. And the first one I want to talk about is the tulip mania. This is in the 1600s in the Netherlands, and it's supposedly the first example of a real asset class bubbles. So for context, at the time in the 1600s, the Netherlands was, as measured on GDP per capita, the wealthiest nation in the world, significantly above all of the other major economies. They were really flourishing. And what happened at the time was that these tulips became status symbols. And particularly the color variants became status symbols. So the demand for those things started to increase, and it was difficult to grow these things. So to grow these color variants, it was difficult to cultivate them, could take up to 2 years to grow. And so the price of these things started to increase. And so for context here, the prices eventually got completely out of hand, and it's reported that in 1637, some speculators paid as much as 5,200 guilders for a single tulip bulb. And to put that into context, you could buy about 208,000 beers at the time with 5,200 guilders, or enough beer to drink a 6-pack a day for 95 years. The annual salary of a carpenter, it would take 21 years of an annual salary of a carpenter to pay for a single tulip bulb at the top of this bubble. So it was on every metric, these tulip bulbs got exceedingly expensive, and then obviously the market collapsed. But I think there's two important things to note here. The first is that this wasn't a systemic event. This was a small niche market of mostly speculators. And despite the fact that tulips at one point got to become the 4th biggest export for the Dutch after cheese and gin and herrings, the collapse of the tulip bubble had almost no impact on the broader economy of the Netherlands at the time. And so I would assume that if you guys were financial advisors in the 1600s, or in 1637 in particular, you wouldn't have had a particularly big portion of your clients' wealth invested in tulip bulbs, and they could have sat on the sidelines and kind of talked about this, but not really been impacted outside of the stories. And so while this was a pretty interesting story, it's not a bubble that we would be particularly concerned about. The bubbles that we do need to concern ourselves about are the big ones. And the first one I want to talk about is the Japanese financial bubble of the late 1980s. And I've got a couple of charts here. So for context, at the time, Japan, during the Second World War, the economy had been decimated, and they were trying to rebuild in this phase from the late 1940s until the 1980s. And the way that they rebuilt their economy was to focus on manufacturing and exports. And they became extremely efficient manufacturers. There was a bit of currency manipulation involved, but they became massive exporters, and that was driving significant economic growth. And they went from, in the late 1950s and the early 60s, they were about 3% of global economic output, and they grew to about 18% over the course of the next 30 years. And that's roughly the relative size of the US economy today. So they grew into a pretty significant economy. They did so by growing about 6 times faster than the rest of the world for a period of about 30 years. And we call this period was referred to as the Japanese economic miracle. And it was a very compelling narrative. Japanese were doing a great job of building that economy. And so inevitably what happened was that as the wealth per capita increased, people were attracted to buying houses, to getting themselves decent houses. And you can see in this chart on the right-hand side of the slide here, this sort of light blue area chart is the house price index for Japanese houses. And this line here is the amount of mortgage debt relative to the size of the GDP of the Japanese economy. And this started increasing over the 60s, 70s, and 80s as more and more people got into the housing market. And that obviously started to drive house prices higher. All this demand for housing started to drive house prices significantly higher. But again, as I said, it was a compelling narrative behind it, this Japanese economic miracle. But what started to happen was that investors started to realize that there were a bunch of listed Japanese companies sitting on pretty big property portfolios, and the share prices for those companies weren't reflecting the value of that property, which was growing pretty significantly around that time. And so guys started investing in these Japanese companies because they thought that they were undervalued based on the value of their property assets. And so then the corporates started to notice that if they had real estate assets, their share prices were getting pushed higher. And that incentivized them to start taking on more property themselves. And this, I guess with perfect hindsight, was where this red line chart here is corporate debt to GDP. Corporates started taking on significant debt, mostly to buy real estate in Japan. And as they did that, they started to see revaluations of their asset portfolio driving their earnings growth. And at one point in the late 80s, about half of earnings growth was coming for the entire Japanese stock market was coming from revaluations of property. And obviously this sort of late entrance of these corporate speculators with leverage was what ultimately brought things to a crushing end, and central banks intervened in the late 80s, pushing up rates, and the whole thing ended in tears. And I guess there's two things that I want to take away from this. When you have systemic sized assets with already some underlying leverage, like housing with mortgage debt, and you add more leverage and speculators on top of that, that's a recipe for systemic disaster. And you can kind of see on this chart on the left-hand side here, when this bubble cracked, the size of the Japanese stock market to its relative to its GDP was absolutely collapsed, as did the house prices. But the other thing that I want to take away from this slide is look at the timeline here. So we've got this chart of house prices rising from, this is as far as I had data back for, but from the mid 60s right until the late 80s. So almost 60 years of bull market, which, with hindsight, as we say, we know turned into a bubble probably somewhere at this point. But the point is here, it's very difficult to time your way around bubbles because they can often last for substantially longer than you think they're going to last. If you had have bailed out after the first sort of 10 years of steep house price appreciation, you would have probably been worse off than had you just stuck the course and rode it all the way up and down again. So timing your way around bubbles is particularly challenging because you don't know how long they can last. The next bubble I'm going to talk about is the dot-com bubble. So this was in the late 90s. I'm not going to spend a lot of time on this. I think Nick will focus more on some of the technology companies and this part of things. But all I'm going to say here is there was a very compelling narrative to suck people in. You had this period in the late 90s, which we call the internet revolution. And you were seeing the number of internet users, more than doubling every year for a few years. And so you just knew that this was going to be big and it had a huge runway of growth ahead of it. And this light dotted line here is the price of the NASDAQ index, which was the tech heavy index at the time, which obviously went up and then came straight back down. There was a lot of speculation here. There wasn't a lot of profit going on back here. The profit came much later. So these other two lines I've got here, this red line is the online ad spend as a percentage of overall ad spend. And now, as we sit today, more than 50% of advertising revenue is generated online, and the other line chart here, this blue line, is the retail spending online as a portion of the pie. And we know these eventually became significant, but at the time we were just guessing where the money was going to be made, and so the prices went probably got a little bit ahead of themselves. But the point is here, if you even had have invested right at the peak of this bubble into the NASDAQ, you still would have earned inflation-beating returns for the next 20 years. And what I wanted to take away from this is that these bubbles can often only become a problem if you get in really late and potentially use leverage and then capitulate early. So if you had have got in really late and then capitulated somewhere in the early 2000s, having lost sort of 50% of your capital, that's a permanent loss that you're never getting back. Or if you had have taken on leverage and been forced to exit after these big losses by margin calls, that's a permanent capital loss that you're never getting back. But the fact that you were early, if you just rode this out, you eventually ended up making money. So capitulating early or sort of panicking in these bubbles is also another thing that can cause more harm than the bubble itself. The final one I'm going to touch on is the used housing bubble. Most of us familiar with this, that created the global financial crisis in 2008. And again, it's debt and housing, these systemic sized assets with leverage underlying them. The narrative here was again compelling in the late 90s and going into the 2000s. You had this narrative saying we'd gone through we were in the great financial moderation, where central banks had spent the 80s and the 70s getting inflation under control. Because inflation was under control now, volatility of asset prices was significantly lower. And this meant that we were able to take on much more leverage without risking negative equity. And so people were taking on more leverage, and as per usual, that finds its way into the housing market. But the problem really came in the sort of the latter part of the first decade of this century, when speculators got involved and banks found a way for people to extract the paper profits from their house via a home equity mortgage, which is this red line that got piled on top of mortgage debt here. And often people were using those paper profits to reinvest in new house prices, and this sort of speculation and leverage, as we know, all ended in tears. So those are the bubbles that I want to talk about. I said I would mention how I thought we could avoid bubbles, and this is where I want to wrap it up before handing over to Nick. But what I will say is that it's almost always very obvious that things were in a bubble after the fact, but normally there's a compelling enough narrative that it's not completely clear that we're in a bubble or in a bull market at the time or when things transition. And as I said, these things can last much longer than you think they can. So very difficult to identify bubbles up front, and very difficult to time your way around them. I would say the best thing to do is to focus on assets that have systemic importance for economies. So the stock markets, the debt markets, the housing markets, these are things that are important to functioning economies, and central banks are going to step in and do what they can to underpin those prices when things get wobbly. Stuff like Bitcoin, central banks aren't going to lose sleep over Bitcoin or tulips losing value. So don't put too much of your portfolio into things that are not going to have systemic ripples and cause central banks to kind of backstop those things. And so it's important to remember, diversify, not putting too much of your assets into things that could disappear overnight without too many people losing too much sleep. And that brings me to where I'm going to end off with this quote from Anthony Robbins on the right-hand side here. Focus on where you want to go and not on what you fear. And this quote is relevant for most pursuits that involve some form of risk. So whether it's this mountain climber dangling precariously at a crazy height, whether it's a mountain biker going down some treacherous path, or a skier sort of taking on some rough terrain, all of these pursuits that involve risk and that have some sort of hazards surrounding them are best performed if we focus on what we're trying to achieve and trying to ignore the things that we're most afraid of, whether it's falling off the mountain or crashing into a tree, or in the case of investments, asset prices coming off. If we focus on our goals, that means that we're able to look at the duration, how much growth we need, get the right asset allocation so that even if we have corrections in the market, it's not catastrophic for us, not too much leverage behind that. And I think that's the sort of secret to success. Don't try and time your way around various asset bubbles. If you find yourself looking at your asset allocation and deciding that you need 60% allocated to tulip bubbles, you've probably got unrealistic expectations about how much growth you're going to get or how much growth you need. And that would be my sort of key takeaway from this. Focus on what you're trying to achieve and use assets well diversified enough with that are systemically significant, that will allow central banks to intervene and moderate those things. And then you can pretty much ignore the bubbles. They'll happen. We probably won't know them in advance. We'll almost certainly know once they've happened. And that's where I'm going to hand over to Nick.
Thank you very much, Peter.
For your time.
And thank you for working out exactly how many beers you can have for 95 years for a price of a tulip thing. That will stick with me. I'd like to hand over to Nick. Nick, if you can share your screen and we'll get going with your prezo.
All right, thanks Pete, thanks Dale. So I'm going to take a look at bubbles, but probably from a slightly different angle than you're used to hearing. So I'll tell you what I'm going to talk about. I'm going to talk about why, perhaps contrary to what Sir John Templeton said when he said the four most dangerous words in investing are, this time it's different. I think in many respects it's always different every time. Why, quite frankly, the best stocks to own can seem essentially indistinguishable from bubbles. And then I'm going to make a case for that we should stop obsessing about bubbles, which I know is ironic given that we're hosting a webinar about bubbles. So my tongue-in-cheek definition of a bubble, what is a bubble? A bubble is typically a financial asset that's gone up a lot that I don't own. And quite frequently you pair that statement with someone who you think is typically a lot dumber than you are, and yet they're making all the money and you're left on the sidelines, which leads to a certain amount of unhappiness. So if you look at the landscape today, I mean, I think it's this chart today is that I've got up on the screen here is the forward PE ratio on the S&P 500 looking back over the last decade or so. And what you'll see is that the PE multiple has consistently gone higher with a few interruptions like the one we had from COVID last year. But essentially we were seeing inflation, valuation inflation. Now, I think there are a number of changes to the environment and the landscape that means that could result in these multiples staying higher on a secular basis, and potentially even going higher than they have been. So in many respects, I think it could be different. So what are these forces? A lot of these should be fairly well known to you. So the first one is this low interest rate regime that we're in. A big part of that is the action of central banks. So it's really monetary policy action. And use the acronym TINA, which means there is no alternative. So if interest rates are essentially at zero or say, 1.5% in the US, it really forces investors out along the risk curve. If you're a pension fund that needs to generate 7 or 8% a year, the traditional 60-40 allocation is probably not going to get you there. So you are literally forced to take a different amount of risk. a newer player that's really come to the fore in sort of the during COVID last year is the importance of fiscal policy. That is becoming a much bigger player. If you look at the policy response during COVID, even relative to the GFC response, it's orders of magnitude. And policymakers were sending, governments are sending checks to citizens just to keep the whole system afloat. Now, it'll be interesting to see to what extent policymakers use these tools, again, just in a normal recession. And if we decide, well, we can get out of recessions a lot sooner, maybe this is a policy toolkit that we can use. It's a policy toolkit. We've got a greater arsenal than we thought we did to reach full employment and our other political and economic objectives. I think this changes that should reduce the downside to equities if you know that policy backstop is going to be there. The third factor, which I think is become increasingly important really over the last, I would say, year, 18 months, is the return of the retail investor class. And I would say particularly young millennial Gen Z investors. And no more was this, the place where this was demonstrated to the greatest effect was with GameStop's share price earlier this year, which driven by, a group called Wall Street Bets on Reddit. People operating on low or no cost brokerages like Robinhood, really pushing these meme stocks to really unthought of heights. But these investors, I think, are rediscovering the market for good and bad. I personally think it's good that young people are involved in the capitalist system, that they understand how the stock market works. Yes, some of them are going to be badly burnt, but I think they will learn from the experience. But this is a new investor class that will look at stocks and I think in many cases evaluate them differently and hold for different reasons than a traditional active manager like myself. They might hold just because they believe in the cause of the company, because it's green or they like it on sort of ESG criteria. But they, I think, are having a fundamentally different way in terms of liquidity in the markets and how various assets are priced. Fourth, everyone will know that passive is becoming a greater part of the market. I would also lump in quant and algorithmic trading, so non-human trading. But why passive is relevant is because passive does not care about valuation. A stock in the index could go up 1,000 times tomorrow, and passive is not selling if the passive vehicles like ETFs, if they get flows, they will keep buying. So they are completely valuation agnostic, and I think this puts upward pressure on PE multiples over time. And then the final one that I'll talk about, which we'll all know about, is really the pervasive impact of technology and disruption, both in the real world and markets. And so I think that's throwing into question a lot of the old rules of thumb that investors used to use, like reversion to the mean and some of these concepts, which are being challenged to a greater and greater extent. You can see the rise of the FANG companies, how they've continuously surprised market participants for coming on a decade now. And I think this trend of technology and disruption, new players coming up, legacy players dying, is only going to accelerate with time. So let's talk about some individual bubbles. And so we all know the Warren Buffett quote, that you should be fearful when others are greedy and greedy when others are fearful. So let's have a look at Amazon's share price. And we all know that Amazon has done phenomenally well, which has led this journalist, Andy Zaki, who I think writes for it's either Forbes or Fortune, to talk about the amazing Amazon stock bubble. And so we all know that what happens after bubbles. And we know how we should respond when we do have bubbles. So we know that we should be fearful when others are clearly being greedy, as in the case of Amazon, which has done so well over time. Well, I've played a small trick on you, and I hope you'll forgive me. But that article was written in 2010, and what's interesting is that the stock that appeared to be in a bubble at that point in time has gone up another 20-fold. What is also interesting is that Amazon is on pretty much the same multiple, roughly about 50 times earnings, as it was then. So you could have called the stock quote unquote expensive then, but in the fullness of time, expensive turned out to be dirt cheap. So I think firstly, one should be very careful about taking these kind of pithy sayings and thinking that sort of blindly applying them to all scenarios. So this goes for Buffett's sayings, it also goes for the John Templeton quote. I think it's important that we are thoughtful when we look at these individual situations. So what's another stock that's clearly in a bubble at the moment? And it's a very polarizing company, and you typically either love them or hate them, and you either love or hate the founder, but the company I'm talking about is Tesla. And so, Rob, this is a recent headline that I found on Yahoo Finance, and it says Tesla stock is a prime example of a bubble, and this is by Rob Arnott at Research Affiliates. And you can see how Tesla has become the largest automaker in the world by a long shot. And so, naturally people will use the phrase price to perfection. And that's another one of these sayings that well-meaning fund managers like myself will say. And I participated in another investment conference yesterday, and I heard another investment manager saying that. And it sounds wise, and sometimes it's right, but it's not always right. And so if you look at the market that Tesla is operating in, you can see that the expectation for battery electric vehicle cars or battery electric vehicles, the expectation for this year is roughly 2 million unit sales in 2021. This is relative to annual global auto sales of roughly 68 million vehicles a year. So electric vehicles are a superior technology. I think it's the cost is rapidly coming down, and the cost of maintenance is superior, and electric vehicles are superior along multiple dimensions. I think it's a matter of time before ICE vehicles are completely replaced by EVs. Now, what does that mean in terms of the potential for annual sales? From the current level, or the 2021 level, that means vehicle sales should go up 35 times. Add to that the global car park, or how many cars are there in the world, and the number is roughly 1.5 billion cars. It may be up to 2 billion cars. If over time we're going to replace all of those cars, that's over a 700 times increase versus the level of cars that were sold, EV sales, just this year. Now, if that's the case, I think it is very much a stretch to say that that is all priced in today. I certainly don't believe that's the case. Now, what would the father of value investing say? Well, I'm not sure, but I just did a quick hypothetical exercise. And you look at what's Tesla's market cap today, and that's roughly $600 billion. Okay, so it looks like a big company. Next, I wanted to look at not where's the growth going to come from just from auto sales, but I'm looking at what's the optionality in the business. And now you start talking about things like self-driving cars and Tesla's robo-taxi network. And it really does sound like science fiction, but it's certainly possible. And I think it's even probable. Difficult to know what probability to attach to that or what the timeline is. But I think there's a decent chance that it's going to happen. But let's assume it does happen, and let's assume that these are up and running by 2030. And so I've come up with some numbers. I'm not going to talk through it and get too much into the weeds. But the point here is saying you can use some really reasonable assumptions. So that if you're a Tesla owner And then you can essentially let your car, your self-driving car, go out into the Tesla network, the robo-taxi network, which will be like an Uber. And while you're at work or sleeping, your car can go out and lift people around, and you can earn money from that. And then Tesla, just like Uber does today, could take a cut of that. Now, if this comes to pass, I think that business, or the market cap just of the robo-taxi network, ignoring the value of the car sales, and ignoring the value of their energy business and the other things that they'll do over time, could be up to $2.5 trillion. And that assumes 15 million cars in the robo-taxi network. Ultimately, if this comes to pass, I think there's going to be more than 100 million robo-taxis in the world. And then the numbers that we are talking about are just staggering. Now, so to my mind, is it possible, is it conceivable that Tesla's not in a bubble if these other things come to pass? I think absolutely that's the case. So I came across this chart recently, which I just thought was quite funny, because if you're involved with markets for any length of time, it's the only time that people are not calling the stock market a bubble. There's some pundit somewhere saying we're due for the next 1929 crash. The only time that's not happening is when we're in the middle of the crash. And even then, they're assuming that we've always got another 50% to go down because the world is ending. At some point in time, will the world end? Possibly, but then I think in that case, we've got much bigger problems. But there's always someone calling for a crash, someone saying we're in a bubble, someone saying it's going to end badly. Usually, they've got something to sell and they've got another agenda. So I would be extremely careful about listening to those people. It reminds me of a quote from Peter Lynch, who was a famous Fidelity fund manager who had a fantastic long-term track record. But he said, his original quote was, "Far more money has been lost by investors preparing for corrections than has been lost in corrections themselves." So I've applied this bubble concept to that. I say far more money has been lost by investors preparing for bubbles than has been lost in bubbles themselves. People spend so much time worrying about bubbles. Oh, we're in a bubble, let's avoid bubbles. I think you can miss some wonderful gains in individual stocks and in the stock market as a whole. So along that same line of thought, I came across this Franklin D. Roosevelt quote where he said, "We have nothing to fear except fear itself," which is not the same as saying the market's never going to correct, we're never going to experience bubbles, we're never going to take losses. But there's no point in spending all your time fearing these things. I think you'll miss a wide range of potential opportunities. So to conclude, I think it's different every time. And the fact that people are saying this time it's different, yes, sometimes that might be an indicator of the bubble, but more often than not, things are different. The world does change. We're not still riding around in chariots, and we're not drawing paintings on the side of cave walls. The human race does move forward over time. Second, if you look at stocks like Amazon, Netflix, Tesla, Tencent, they go up so much that you could argue they're virtually indistinguishable from bubbles. And yet those are the stocks you want to own. And then finally, I think spending an inordinate amount of time worrying about bubbles, obsessing about bubbles is counterproductive. And I think it could be more dangerous. It could be more dangerous than avoiding the bubbles. So I tend to view the world with a glass half full approach. I'm more of an optimist, and so that's my perspective. But I think there's a world of opportunity out there, and it would be such a pity to miss it because one is afraid of bubbles. And with that, I will hand back over to Dale.
Thank you very much, Nick. And it's wonderful to actually have someone in these times that actually is an optimist. If I could ask you all to enter your questions now. I see there is a number coming through. So let me start. Peter Little, are you with us?
I am still here.
Yes, a little first question for you. Peter, did you see any signs of the crash in 2008?
2008. Yeah, I mean, as I said a few times in my presentation, the narrative at the time is always very compelling. It's very difficult to differentiate from a bull market and a bubble. It's obviously obvious in retrospect where we look back at the stats and say, people were potentially taking on too much home equity. But for me, there were worries, but there's always stuff to worry about, as Nick said. Like there's plenty of stuff to worry about, but if you focus on that, you'll never get anywhere. And in 2008, I was actually living in the US at the time. I was in New York. My wife had got pregnant with our son at the early part of the year. And so in July 2008, I bought a house when my wife was in I think what they call the nesting phase of pregnancy, where she was very unhappy about the apartment we were renting in Manhattan at the time. And so I joined the throngs of people who were desperate to buy Manhattan houses just before they all came crashing down after the Lehman collapse. So for me, it obviously wasn't particularly obvious at the time. I think the good thing was I eventually sold that house for more than I bought it for. So, fortunately, I wasn't forced to liquidate in 2009. But yeah, I think there's always a very compelling narrative. And you always get people who will say afterwards, oh, it was so obvious, like, the hindsight specialists will always tell you that it was clear that was a bubble at the time. And maybe they did think that at the time, and a lot of people could have, predicted that at the time. But I would say it's generally very hard to know that you're in a bubble and to figure out that you've transitioned from that phase where you're in just a regular bull market to the phase where you're in a bubble. Usually there's lots of speculative activity and leverage around, but again, that can go on for sort of 10 years before it all ends in tears. So timing your way around that stuff, I think, is a fool's errand.
So Nick, I see that there's a plethora of questions for you, so we're going to keep you on the line for a bit here. First question, do you think technology stocks will continue to rise and push markets higher in the next 5 to 10 years? And what areas do you think won't do well in the next 5 to 10 years?
So my focus tends to be really I choose stocks one by one on a bottom-up basis. They do tend to be, so my focus is on what are called multi-baggers. That's a Peter Lynch phrase, companies and stocks that can go up 5x to 10x over the next 5 to 10 years. Quite often those are technology stocks, or companies that are enabled by technology. And I've called it the second Cambrian explosion. So I just think we're seeing so much innovation, new ideas, new platforms emerging, companies being built on those new platforms that for me, I think, I think those technology, as it's sort of very sort of broadly termed, is going to do well over the next 5 to 10 years, and I think that will probably bring the overall market, drag the overall markets with them. Whether that's the mega caps leading the way, I think they probably do well. They're sort of FANG stocks. I'm not sure that they will lead the market in the same way that they have over the last decade. And then I think you just got to, what won't do well, I think you've got to look out for stuff that's going to be disrupted. So I think you've got to be careful in, I would say, energy. I think the world is moving towards sustainable and renewable energy sources. That is going to happen. So I think you've just got to be really careful with those companies. I think the legacy banking areas could come under pressure as sort of digital wallets and sort of fintech solutions come up. And then, I think you really got to sort of examine the question on really almost down at the product level and say who's doing the best job of serving clients in terms of, better convenience, better features, better value add, all of that kind of thing. And so if the company, whether it's a new technology or legacy company, whoever does that better, I think that's who wins. So
Nick,
just got to be careful.
Would you be buying Tesla at these prices?
Yeah, so with the massive proviso that this is not an investment device, I'm very bullish on Tesla, as you could tell by the presentation. My skill set is not sort of timing when these things are going to bottom or top. But yeah, I think Tesla's got the potential, with no guarantees, obviously, of becoming the world's largest company and world's most profitable company by a long, long way. So I'm bullish, for sure.
Peter, a question for you. If the ANC weeds out corruption, as they are busy with now, what other factors remain the same? And other factors remain the same, including the dollar printing in the US. Will we see around a 5 to 6 rand weakening per annum for the next 10 years?
Yeah, that's a good question. So we're saying that everything stays the same. I think obviously the one big constraint to our economy is the electricity supply. So I guess I'm assuming in that question that if corruption's weeded out, that we get Eskom back on track and we have more than enough energy to do what we want. I think if you assume that we revert to sort of a normal run rate based on emerging market characteristics, where we're growing our population pretty quickly and we're improving efficiency and the economy can grow pretty fast, I imagine that we'll get some inflation coming back. And that's ultimately going to be the biggest long-term determinant of what happens to the rand relative to the dollar. So we would assume that over the longer term, the rand will depreciate at the differential between US and South African inflation. So assume we get back to a sort of middling scenario for the local economy, and inflation is around, call it 4 or 5%, and the US does a good job of containing their inflation at less than 2%, then I think you're in for about 2 to 3% depreciation in the rand for periods of time. And obviously, short term, who knows what happens to currencies, but longer term, I wouldn't expect as much as 5 to 6% depreciation on the rand if we were running at a relatively good clip that allowed us to absorb or digest some of the debt that the government and individuals have taken on, and we're on a kind of generally improving trajectory.
Thank you. Nick, question for you. Is inflation dead? If it comes back in a meaningful way, where does the US long bond go to? And what does this do to the short to medium outlook for expensive growth stocks like Tesla, Amazon, and Netflix? Nick, you're on mute.
Okay. Yeah, I think my take is I'm with the Fed. I think that inflation is transitory. If you look at, and I think we're in a really funny period because of COVID, and we've got all these bottlenecks popping up. And if you looked at the inflation basket, what's driving it? It's weird stuff like used cars, airfares, out of home lodging, and so there's a lot of there's a mix between sort of shorter term stimulus and then supply side constraints. Why I think there's not going to be, why I just don't see much inflation on a secular basis once we get through this sort of very messy period is I think in large, well diversified, predominantly developed markets, and you can include China in there, is that the supply side works phenomenally well. So when people speak about inflation, they typically focus on the demand side. And there's reasons to believe that I think even on the demand side, it's very difficult to see like a really pronounced credit cycle, which often drives the sort of demand side, given levels of global credit penetration. But on the supply side, as economies open up, these bottlenecks are going to be solved. So you've seen like lumber prices initially shot up, but that was a very lumber specific story, but the supply side is responding. And I think you'll see that everywhere. So I don't think that'll happen. And then also, like, I just think technology is also just making it easier to I mean, what the capitalist system, the way I think it works and the way technology works is it works to bring on incremental supply at low cost. As if you think like an Airbnb, you can add effectively 1,000 hotels like with a click of a mouse kind of thing. So, which is inherently disinflationary. And then the other thing I think is the current period is not like the sort of the 70s, because the resource intensity of economies has just gone down and down over time. So the raw material commodity impact is a lot lower. And I think it'll keep on going lower, particularly as we move towards more kind of sustainable energies and driven by companies like Tesla, and we use more solar, less kind of oil and stuff. So it's, to me, like, I'm open-minded to the idea that inflation could be higher, and particularly if I think fiscal would need to just play a pronounced and more consistent, like they'd have to ramp it up massively and just keep it there. But even then, I mean, if the fiscal goes into bringing on sort of new roads, bridges, fixing up the sort of decaying infrastructure in places like the US, if it goes into, more solar infrastructure, if it goes into the supply side of the economy, I think that's disinflationary. So that's that. So I think, secular, I don't think inflation rises. Second part is, though, to the extent that the market obsesses about inflation and drives up interest rates, shorter term, clearly that's a headwind or it has been a headwind to growth stocks. People rotate into value stocks, into cyclicals. But history has shown, if you look at the late 2000s, we had a bubble in the NASDAQ and growth stocks, even where the long bond was, ranging between 4.5% and 6.5%. And so people weren't put off by higher inflation and higher bonds. And in the steepest part of that run up, where the market went up, the NASDAQ went up 200% in 18 months, or whatever the number was. I think the long bond was up from 4.5% to just under 7% in 18 months. So I think the more important factor is like animal spirits and risk appetite. So, yeah, I think that this kind of current narrative is flawed, at least judging by history. And I think, the market will digest it. And I think, high growth stocks, I think they'll have their day in the sun again.
Thank you, Nick. Question for you, Peter. What is your take on the NASPERS process share swap? Pete, you're on mute.
Yeah, sorry, the NASPERS process share swap. So, there's two aspects to it. I think it's clear that the NASPERS guys are working incredibly hard to try and unlock some of that discount to the underlying investments. So they're incentivized to do that. You can bet that they have pretty much every banker in the world is throwing suggestions at them for how they should do that. They have some pretty tight constraints around exchange controls and keeping their local tax base. So they have a very complex problem to solve, and they have some very smart minds working at this. And I think this is an interesting thing. We've put out a more detailed note on it, but the gist of it is that you're issuing stocks at a lower discount to buy stocks at a higher discount, and so that's accretive to the NAV. So mathematically, it all makes good sense. I think you can increase NAV by about 6%, depending on how many people take up the offer. And so I think sort of mathematically they're solving a problem for unlocking some of the NAV discount by just improving the NAV with this transaction. I think the challenge is that we've seen, just from a sentiment perspective, with these holding companies, that when you have things that add complexity, they generally don't bode well for unlocking discounts. So you have these two competing forces. Practically and theoretically, they've done something that will increase the NAV. And then you've also added this complication of now you have a cross-holding to kind of try and factor out, which adds complications, which will probably not do a lot for sentiment. So you have these competing forces. I think they probably net out with a slight increment to the NAV.
Pete, just to follow on from that question, NASPERS or process?
If you were going in with new money today, I would still probably go with Naspers. I think it has more discount. It sort of has more runway to unlock discount than Process. I think Process is slightly cleaner, and it has the benefit of liquidity of being on the European exchanges. But I think you have just a better scope for, like, the magnitude of the unlock is working in your favor on the Naspers side.
Last question for you, Nick. The interesting one. Would the decentralized financial system being created by a disruptor to the current financial services industry by providing services directly to clients, specifically to the younger generation, that would prepare this, which would prepare this way of financial services compared to the current system? So I think, just reading through, they're asking, does this new decentralized financial services system pose threat to the current financial services industry?
So look, it's so early days, so it's difficult to know, and I'm certainly not an expert on DeFi. But I think over time, I'm realizing it is something that I need to take more seriously. And so I think it's best to assume that I think the risk with a lot of these things, and the risk with like sort of Bitcoin, a year ago, 2 years ago, 5 years ago, 10 years ago, is underestimating these things and underestimating the potential for change. And so, yeah, I absolutely think that could disrupt the current status quo. But then you've got to, like, as I say, you've got to go back to first principles and say, is it offering better value to the end customer in terms of like price or convenience or all of those things? And I think in many cases, the answer is it probably will. So, without having a huge amount of knowledge on this, I would say my bet is I think it could well be disruptive. Yeah, so watch this space.
Guys, that does take us to 3:00. Thank you very, very much to Nick and Peter for giving of your time. We will send out a copy of the recording. Thank you very much for joining us for Essentials, and we'll see you next month for the next one. Thank you and goodbye.